Hi, Michael Fox, and this is a Prospector podcast. And we are on location at the Mines and Money event in Miami, Florida. And I am sitting across from wintertime Florida resident Mike McGlone, the chief commodity strategist at Bloomberg. Welcome, Mike.
Hello, Michael. It's good to see you again. Good to be back. And I'm actually here full time starting in 2021. And big congratulations to Canada's win in Canada's game in hockey. But I have to admit, a couple of years here now, I'm really appreciating not being in the heart of the cold in the winter. And I fully respect everybody who's there.
Yeah, I was watching the game last night in a bar here in Florida and said, nobody plays hockey in Florida. And I'm going, you're the Stanley Cup champions. What are you talking about? But, that's the way it was. But it was a good game. I think the right, I'll wave myself in the red and white and say the right team won. But we're looking at other sports out there in the commodities markets. And I got to tell you, Mike, there's something that's happening right now that's not on anybody's bingo cards, and that's copper maintaining a high price.
Yes, one of the best performing major commodities this year. It was up about 15%. Now it's closer to 12%. And to make the call, I think it's peaked for the year, peaked potentially at 484 was a high in Dr. Copper, the per pound price on Valentine's Day, February 14th. The reason I think it's peaked is very similar to last year's peak, around $5.20 a pound, on the back of a massive widening spread between CME traded and LME traded copper futures. So there's a big spread there. Obviously, it's tariff fear related, but it's a good signal from markets. And you have to look forward to yourself is what fundamental underpinnings of the rest of the world facing higher tariffs in the world's largest importer is going to really help copper go up. So I tilt over to China and start with bond yields. 10-year note yield in China is around 1.76 this morning. In the U.S., they're starting to drop towards 4.45%. There's a lot of room. But overall, bond yields in most of the rest of the world, particularly in Europe, let's look at Germany, the third year potentially towards economic recession, UK tilting towards recession, are all starting to drop. I just don't see the upside for copper. It'd be wonderful if it could stay above the highest closing month-end price for copper ever. It was $4.75 on the March of 2022. We all know what happened then. Russia invaded Ukraine. And I think it's bumping up against pretty good resistance. Also, one thing that copper always does, it's very highly autocorrelated. Everybody gets bullish when it gets near 5, and it goes back near 4.
Yeah, it does. It tends to bounce off its tops and bottoms quite a lot. All the, we refer to it as Dr. Copper. It's generally an economic indicator. The economists going into the year were all talking about headwinds, tariffs. That's going to push, the world into a significant recession, possibly towards the end of the year. But copper rose in spite of all of that. Yeah. So what is copper seeing that the economists are missing?
I think it's point in time. Virtually every commodity got hit pretty much at the end of last year. It's called liquidation, massive outflows of ETFs. I'm sorry, not so much ETFs, but futures, open interest, big inflows all over all commodities this year. Big, typically there is at the beginning of the year. And so I think it's just a reversion of that. Also, it's a tariff risk. But the key thing I think about copper is there's the elephant in the room for virtually all risk assets, and that is the U.S. stock market has to keep going up. Yet, PE ratio basis versus the rest of the world, it's very expensive, the most expensive versus the MSCI ex-US index. So I think anybody who's doing analysis this year for anything has to assume either US stock market either stays the same or goes higher, because that's all it does anymore. Yet the biggest risk is it just has a normal 10% correction and all the dominoes tumble, which to me is a key risk that copper is potentially, it's picked up on optimism, but think of the time of year it is. It's February. Now if it picks up later in the year, that's great. But here's the key thing I think is going to really matter is one thing I really like watching is that gold copper ratio. Right now, it's about 640 pounds of copper per 1 ounce of gold. That is the economic malaise danger zone. The last time we were there, the first time we reached that level was 2008. We all remember that. The second time was 2020. Both major economic issues. Second was the pandemic. Now we're bumping up there now. The thing that just switched this morning is gold ETF holdings just reached a 1 year high. So if you overlay gold ETF holdings with that ratio, it's starting to kick up higher. And I think we're seeing actual investors, ETF investors, kicking and buying gold rather than just central banks. Copper, good luck. It's one of those things I love for it to go up to show those organic global demand pull forces from the Dr. Copper. And I think the risk is the gold copper ratio continues to rally. I think copper's peaked, and gold is just a matter of time. It continues to get to that 3,000 level.
Yeah, it's you talk about that malaise, and then you nailed a warning sign of what happened in 2008. So if copper is in fact peaked for the year and going to start to move down, given all the economic pressures that we've already discussed, and gold, because of the same economic pressures that we've discussed, continues on its upward trend, that gold copper ratio is going to start to increase even further. It's not going to be a breaking point. Are we reaching the potential for a danger of a repeat of a 2008 type crisis?
Sure. The market, to me, stock market very much feels like Q1 25 years ago, 2000. Remember, we were at record highs. We have massive speculation in cryptocurrencies, very similar to dot-com bubbles. And so you have to depend on that stock market. It has to go up. Anybody who's making any decisions in any risk assets, particularly the two key commodities that are very economic sensitive and stock market sensitive, copper and crude oil, have to be looking over there. Okay, I'm okay if I'm long copper as long as the stock market goes up. A fact of how markets work when they get this expensive. The key thing that copper has for a potential peak is, number one, yeah, I'm willing to take the risk of making that high, but it has pretty good companionship in crude oil. WTI crude oil right now is about $72 a barrel. The high for the year was 80 at the beginning of the month. Remember the time of year when all the hedge funds and the speculators and the futures guys all jumped on board, got long? We saw that last year when it peaked around 90. Hedge funds, speculators got way long, and then it dropped to around 68. Think it did again. So I think if crude oil's peak, and also we have some major incentive from the new administration in the U.S. is stated goal for lower energy prices and lower interest rates. I mean, when Biden did it, he wanted lower gasoline prices. He released the Strategic Petroleum Reserve. I would not underestimate the resolve of this new administration to do that. They have the ability and they have pre-existing trends in their face, so and in their favor. So copper potentially peaking with crude oil. McGlone's making the call. The one thing I've been wrong on so far this year is natural gas. U.S. natural gas is above 4. Now, we've had an extremely cold winter, as we know, particularly in the U.S., but in Canada, which is what you need for natural gas to stay above 4, which it is now, like 4.3 or so. But that's in an environment of global warming, and this has been a one-off. So all the above are kicking in, and that's why I think it's even corn potentially is peak. So copper is just part of the game. It's just the one that's the most macroeconomically sensitive. And it's the one I'm watching the closest because as someone who I'd love to get bullish risk assets, not from these levels, copper has to go up. And to me, the risk is it goes down.
Okay. Given the risk is to the downside, so far, Trump's favorite word is tariff. It's the most beautiful word in the English language. But most of it, it's been the threat of tariff, with the exception of China, where they've actually enacted the tariffs. Does copper really start to make its move down once Trump starts to actually enact tariffs? Or is it a question of, the tariffs come, the economic fallout for that happens, then copper moves down?
So that's the unique thing about it. Markets are supposed to be forward looking. We all know tariffs are coming, but the neat thing I think people are underestimating is the persistence of this human being who's now become a second-term president after 4 years of sitting in Mar-a-Lago, which is 53 miles north of where we are in South Miami. He has a destiny. He knows he's got destiny in the world. And he sat there and thought, if I get a second chance, am I going to mess it up? He's got the second chance. And then you look at that book, the No Trade is Free, but Robert Lighthizer pointed out whole tariffs are just way overdue in this country. It's been, I mean, between U.S. Canada and U.S. Mexico, I disagree with the high tariffs, maybe some little bit more reciprocity, but they're going to work that out. But definitely with Europe and China, these are things I spoke about 30 years ago. But the point is, don't underestimate is the purpose of this new government to try to, as Robert Lighthizer said, to stop the exporting of U.S. wealth to the rest of the world, particularly China. The largest military in the world is now in China, and it's built with U.S. dollars. So to me, that's the key thing to look forward to, is we will be getting something happening. There's a negotiation. The point is, the U.S. is the world's largest importer. People like to compare it to Smoot-Hawley in the 1930s. We were pretty much of a net exporter then. So this is a significant shift in the world order. And I think what you need to do is markets can't be easy. Like, Copper ended last year around 4. It's pumped up to about 4.84. Sure, it's got to stop out anybody who is bearish like me and go back down. But it's going forward that matters. And as far as the tariffs and everything, I think people should not underestimate that. But the facts are that China, first of all, with copper, you have to start with talking about China first. And one thing I'll mention with copper, if you take that copper price right around 457, 460 now, convert it to a decimal, it's basically been the same as the U.S. 10-year Treasury note yield since about 2015. And it looks like they're potentially heading lower. But the key thing to point out is what's happening in China. China's yields are 1.7%. That's severe deflation. So I look at it, bond yields are telling us where things are going, particularly in China. Don't ignore what they say, watch what they do, watch what markets are doing. And that's where copper is right there in the middle. And I don't see how things are going to get much better from China. It seems to me it's very much a situation of what I used to trade Japanese government bonds in the 90s. I remember happening in Japan. Their GDP right now is the same as it was 30 years ago. Potentially, China's probably plateaued. Their major exporters are going into export targets. Customers are going into recession. And peak Soviet Union. Now we have an autocratic leader there who's more autocratic than before Mao. You have to go back pre-Mao. So this is from all the things I've read. So when you rope in copper, rope in geopolitics and markets, something has to shift. Copper is completely dependent on more and more fiscal and monetary stimulus from China. It's dependent on demand pull from the U.S., which is being curtailed through tariffs. It's dependent on demand pull from Europe, which is tilting towards recession. What shifts that? Right now, I think it's been a bounce. If it can stay above 475, that would be great. Normal reversion is towards 4. And if Mr. Bessent and our leaders get what they want as far as bond yields and energy going lower, it could head towards 3, especially, and I'll end with this, the most important factor is U.S. stock market having just a little bit of a normal correction. That's what it's way overdue for. And I'm predicting it this year. Here's something I'll end with. I like to put this out. Remember those days, where you and I are both seasoned, used to have 10% corrections in the stock market and they were normal? We have not had one since Q4 2023. We're overdue just to get to that 200-day moving average and see who's wearing clothes.
Yep. No, we are certainly overdue for that. And that was one of the questions I was going to pose with you with regards to the U.S. stock market staying high. Let's pull up the limbo stick question. And how low can copper go?
Yeah, well, normal reversion is 3. Every time it's been up to 5 since first printing there around 2020. The lesson is, let it go, hit the bid, and let it go back to 3 and buy it back. Is it different this time? I keep saying it's one of the world's most autocorrelated commodities. Yes, it's almost the same, like I said, almost the same as U.S. bond yield for almost 10 years now. So something's basically got to happen, and China's got to completely come out of this malaise, which I doubt is going to happen. You're going to see more in fiscal and monetary stimulus, a shock. And so I don't know what keeps it higher. I'd be wonderful if it does. Some kind of supply shock, which is very rare. There's kind of diversive supply from copper. So that's why I think is this feint this year is a bit more of a risk that you're supposed to be selling. I don't give investment advice. I'm just a strategist, but it also has a lot of other commodities in the background. Crude oil is unlikely to go higher. And there's a pretty excessive amount of U.S. supply from U.S. and Canada, from OPEC, and declining demand from China. There's EV demand, electrification. We all get that. But I think I'd say good luck. I hope it can stay above 484 or so. I think it's more likely to drop towards 3. But the first key thing in the middle is 4.
Okay. Let's shift away from copper. Let's go on our way back machine. We'll get Doc Brown out here and we'll hop in the DeLorean and go back to May of 2023. You and I were sitting doing one of these at a conference in New York City, hosted by the SME. And at that point in time, when gold was probably down around 1800. You projected 3,000 gold, and you did so on my pod. You did so in front of the room, and there was some light chuckling and eye rolling that occurred. And here we are, end of February 2025, and gold's in the mid 2900s. Do you feel vindicated, or does it actually have to hit 3 before you'll feel vindicated?
Well, that's the thing I've learned having done this for almost 40 years, starting in the trading pits, which is great because it's in your face. you make a mistake, someone just punches in the face. I mean, it's just the way it was a little more physical, which it's a great way to learn that I learned really early on in business. When you have a view and you express it and everybody agrees with you, that's a problem. It might feel good physically, mentally, but it's when everybody disagrees with you, which usually means you're going to be right. The lessons of, when we generally anticipate don't occur. So I really appreciated that. That made me more bullish. Now I'm concerned. A question I like to ask you and anybody is, have you heard of anybody who's bearish gold?
No, I don't know anybody that's bearish gold, but I don't know anybody that's hyperbolically bullish other than the usual carnival barkers that are, been screaming for 10,000 gold, for the 22 years that I've been doing this. I think that the market wants 3,000. But I think after it hits the 3,000, you're going to see another a gold correction. That would be my projection on it. But you're the senior analyst. You got the job working for Bloomberg. I don't. So, what do you say?
But darn, we agree. It's one thing you learn so that's one thing to respect all our listeners. Those who do, I completely respect you and are bound your general directions. I'm a former trader. I don't trade. Investment is all long-term stuff. So former trader, I can typically see when I would have been stopped out and right or wrong. And I just don't see what stops gold from going higher, particularly what we just noticed this morning, the February 21st, gold ETF holdings by the Bloomberg's metric just jumped up to the highest in about a year. Now, that's the key thing. We've had 4 years of outflows from gold ETF holdings. So investors in the U.S. and Canada and most Western countries don't give a damn about the rock, even though it's been beating the stocks for 3 years now, S&P 500. So to me, that's going to flip. 4 years, I'll make another call. We will have gold ETF net inflows this year, but the most important thing for gold ETF inflows from an investor standpoint is when they start looking over to that stock market and realizing, oh, okay, it's really lofty. It might be going down for a while, and looking over at interest rates and said, yes, they're very high. They might be going down. That's the kicker for gold to get to 4,000. Now, not right away. 3,000 is very good resistance by almost all measures. But to get above the next level, you have to go through the fight. So remember when it first went to 1,000 in 2009 or so, it hung out for a year and a half. It goes to 2,000, hung out in 2020. Now, I was bullish gold in 2021, 22 to 3,000 for almost 3 years. So had to have my face ripped off. That's the way it is. And finally it did it. Now it's at 3,000. And I'm hearing all the bullishness, it's somewhat pared back the way you said, because people can still look over and say, well, why should I bother when I can get earnings in the stock market, which by the way are the lowest in 20 years. And by the way, the PE ratio is the highest since like 2000. So that's what I think is happening. But the bottom line is underlying bid for gold is central banks. The de-dollarization is silly because there's no other currencies even close on the planet except for gold. And then there's one key thing I want to mention that's, I think, the most significant, best leading indicator for gold potentially going higher is Bitcoin going lower. Digital gold, it was the biggest launch ever of ETFs last year, and your average 30-something doesn't give a darn about boomer rocks, as they're called, gold, when they can buy Bitcoin and cryptos. But now that space is full of speculative excesses, in excess of what I recall in 1999 and 2000. Some of us who got it right were just early. So to me, when the market starts going lower, maybe a reversion of risk assets, and Bitcoin and cryptos are the riskiest, that makes gold shine. But it's a long-term down the road. We'll see how things look out by the end of the year. But here's the key thing, I think, for gold to stay under 3,000, or to bump up and not be able to stay above 3,000, if that U.S. stock market interest rates in the U.S. stay high.
We're still early in the year. It's end of February. We've got a couple of months under. We've got a month of a new administration in the United States. What in the commodities markets right now is below everybody's radar that they should be paying attention to, that you've noticed already?
So one thing I love about our conversation is we're extemporaneous. We do not prepare, and I like that. So that's a good question. Under the radar, the most significant next big trade related to commodities, I think, is U.S. Treasury long bonds. Now, I say that because they're related, and you should see the signals of deflation from commodities first. Reason I point that out is one significant factor on a global basis. If you look at the 10-year note yields, government yields from the top 5 countries in the world, other than U.S., that's China, Japan, UK, Germany, and India, that average is about 120 basis points or so less than U.S. So that's those severe deflationary forces from the rest of the world facing tariffs that basically are just getting started. The world's tilting towards recession. And at the same time, the U.S. stock market in U.S. is showing some pretty severe inflation when you compare rise in U.S. stocks versus declining bond yields in China. That's a huge disparity. So what's going to make that crocodile jaw narrow a little bit? And so I think the key thing from commodities is that gold is continue to rally. Let's look at ratios. Gold silver ratio is around 90. I think it goes to 100. So gold continue outperforming. Gold crude oil is around 42. Continues to rally. Probably heads towards 60. We'll see what makes me wrong in that. Gold copper we mentioned already, 640 pounds of copper. I think it heads towards 7 or so. And so to me, the key thing is that this little bump we had early in the year, Bloomberg Commodity Index up almost 10% at the beginning of the year, but massive inflows in futures open interest, which shows everybody getting long, goes downward. The key thing that can really shift that is what we've had already this year. Pretty severe weather. So we've had very cold weather in North America. It's kept natural gas up. But if we tilt back to normal global warming, natural gas will drop. And the bottom line for everything is for commodities to stay stable, the U.S. stock market has to go up. And I didn't say stay stable. So look at last year. We added $12 trillion of wealth from the stock market last year to overall wealth in this country. That's the most ever. That was 40% of GDP. That's an unsustainable force. But to expect the Fed to ease in that environment is silly, and they're figuring it out. What they figured out is the questions are the same, but the answers have changed. You can't ease when risk assets are on such a tear. You have to actually take away the punch bowl. So to me, that's the big picture. I'll end with this. The lessons of history that almost always, when you get severe inflation, which we had, which was mostly all man-made because we pumped up too much liquidity system, you almost always get deflation. Why? Because assets and valuations just come down from that higher plateau. To me, that's the biggest risk. And that's why I think copper should break down. And it'll be first key indicators. I'll be wrong if copper can stay up.
Wonderful. It's been a pleasure, as always, to run the gamut of the commodities with you. As you say, the questions don't change, but the answers certainly do every time we talk. And I look forward to having this conversation again with you in a couple of months, and we'll see where things are at. And, the muddy waters maybe will look a little clearer.
We'll go. And if I'm wrong, throw me down on the mat and we'll figure it out. Then what's the next move?
Yeah, absolutely. Again, thank you very much for your time.
Thank you, Mike.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.